What's up, everybody? Welcome back to another one of my live streams. My name is Caryn Gardiner, in case you're new to my channel, and we have a great live for you tonight. We're going to talk about the housing market like we always do, but we're really going to focus on mortgage interest rates because they keep going up since the Fed cut rates, and I kind of want to know what's going on. So I've got a couple articles to reference, and I have a fantastic guest that I'm going to bring on. She's got a lot of experience in the lending world. Her name is Francki Francesco. She is the branch manager of Origin Point. She has been doing loans for over 25 years and has closed more than $1.25 billion in loans. So very experienced, very smart. So let's bring her on. Hey, Francki.
Caryn, hey, how are you? Thank you so much for having me today. This is so exciting, and I'm really ready to dive right in and help you answer any questions or any of the questions of all of your amazing followers in your chat today and in your live stream. So let's hear them, and thank you so much. You are just a wealth of knowledge yourself, and I'm beyond excited to start.
Thank you for saying that. So that's a good reminder. If you are watching this live and you have any questions for me or Francki, put them in the chat. And if you're watching the replay and you have any questions for either one of us, put them in the comments and we will definitely get back to you. Okay, so first I wanted to start us off with this article. So let me share my screen. Okay. Weekly, so this is written today. Weekly mortgage demand tanked 17% after interest rates hit the highest level since August. The average contract interest rate for 30-year fixed-rate mortgages with conforming loan balances or less increased to 6.52% from 6.36%. Refinance demand fell 26% week to week. Applications for a mortgage to buy a home dropped 7% for the week. So I'm just going to read the first sentence and then we'll take it from there. Mortgage interest rates rose last week for the third straight week, hitting the highest level since August. So I don't get it. Like the Fed reduced rates and then mortgage rates just continue to go up week after week. What's going on?
You know what? That is a really loaded question, because the first thing that most consumers don't realize is the Fed cutting the Fed funds rate doesn't trickle always into mortgage rates. And that is the first misleading piece of information out there. You'll hear in the media them talking about the Fed getting ready to cut the Fed funds rate, which certainly helps credit card debt, car loan debt, even home equity lines of credit get lower rates. But with mortgage rates, they're a little advanced thinking. So when you saw those lower rates, you were seeing those about 2 to 3 weeks prior to the Fed announcement, because they were anticipating a Fed rate cut. But the real important thing to know is that the mortgage rates are traded off of the Treasury. And so those are two different figures altogether. And until they connect a little bit tighter, or we see that we really have hit our inflation numbers, which is the number one indicator to mortgage rates, you are going to not see a drop in interest rates, because there's too many other indicators out there, Caryn, that are still saying we're in a little bit of dangerous waters here when it comes to mortgage rates and finance debt.
So I get that. I know that the Fed doesn't directly have anything to do with mortgage interest rates, but it also does influence mortgage interest rates. And I think the feeling was, if the Fed's ready to reduce rates after all this time, it's because things are looking good, or actually it's because things are looking bad, because they reduce rates when the job market isn't as good, which is also very confusing to me. But I think that the vibe was like, if the Fed's ready to do this, then hopefully the banks are as well, as far as mortgage interest rates. And so although we've spoken about this in our meetings, and I had a lender on a couple of weeks ago, we understand it could be baked in. Now we're seeing rates actually go up week after week. Do you think that's going to continue?
I don't think it's going to continue, because we are going to probably see 2 more rate cuts. Again, the Fed funds rate cut before the end of the year. But what we won't see is how that always directly affects the mortgage rates. Because if inflation doesn't correct itself and get down to that 2% level that they're looking for, we are not going to see rates drop that much. But here's the best piece of it all. We are still down 200 basis points than where we were last year, meaning mortgage rates this time last year were in the upper sevens. So seeing rates in the sixes, while I know it's still not that magic bullet that everybody's hoping for, the mid fives, a 6% interest rate or a little bit over 6% rate is still a really strong mortgage rate. So I do think that we're going to see rates trickle down, but there's just too many other indicators out there. We've got an election ahead of us. We've got unemployment figures that are way skewed. We still don't feel strong about our economy. Our inflation numbers are not where they need to be. And we have a lot of credit card debt.
Yeah, let's talk about that, because when you came and spoke at our sales meeting last week, we were talking about the housing market, as we always do, and we were talking about rates. And Steve, my manager, always brings you up to talk about what's happening in your world. And one thing that you said, which I was really not surprised, but I thought was really interesting, because how it really directly gives us a viewpoint of the economy, is how high credit card debt is. So I actually was doing a little research before we went on. I want to share this other article with you. Hang on a second. Okay, so this is from August, but I don't think it's gotten any better. Credit card debt hits record $1.14 trillion, New York Fed research shows. And they go on to say how credit card debt has just gotten worse and worse. Collectively, Americans now owe a record $1.14 trillion on their credit cards, according to a new report on household debt from the Federal Reserve Bank of New York. So I'm assuming that this directly affects if the Fed wants to reduce rates or not. But more importantly for me, it tells me that things aren't going as well as we may think they are if people are getting into such credit card debt.
Right. Well, we go to the grocery store, and so we see what those prices look like. And a lot of times people just can't afford things, so they put it on their credit card. They've got to feed their family. They've got to put a roof over their head. And unfortunately, credit card debt is where they go to first, right? It's easy to get a cash advance, to refinance your home or qualify for a home equity loan. When you're feeling tight or strapped, well, that's a whole different animal. So you're going to constantly see credit card debt creep up, as we could again be fearing maybe recession. We don't know yet. That's why they're trying to fix the inflation number first by reducing these interest rates, and hope that we can get down to that 2% level that's so imperative to get to.
Mm-hmm.
But one of the things I was sharing with you in that meeting is, when you are feeling strapped each month, you're not going to see a lot of mortgage default. You're going to see instead just constantly higher credit card debt and more debt on credit cards. Thank goodness for the Fed funds rate cut, because hopefully that did help reduce some of the interest rates on credit cards. But holy smokes, those credit card rates are in the 20s, in the upper 20s for many people. So it's just hard to get a handle on that and really tackle that debt. So you are 100% correct that where we are seeing a pickup in loans actually right now are cash out refinancing, because folks did year over year build so much equity in their home over the last 4 years. They're now rolling in a lot of that credit card debt to get it manageable and put it into their mortgage over a 30-year term.
So that's interesting. So you're seeing, I know like the minute rates went down, even before the Fed reduced rates, you probably had a huge increase in refis, because there are a lot of people that bought homes in the last couple of years. Sometimes it was as high as 8%, depending on their personal situation. But to, have it go down in the sixes, I imagine that's a good time to refi. When is it exactly a good time to refi? What is like the gauge between what your interest rate is and when, including the cost of refinancing, what you should look for?
That's a great question. I say there's a few different factors to look for. The larger the loan amount, the least amount of spread you need, right? Because
Okay.
when you're refinancing $1 million mortgage, if the interest rate goes down by 0.5%, well, that's a lot of money. That could be $400 a month in monthly savings, sometimes even more, by just a 0.5 point cut. Where if you're only borrowing $300,000, that 0.5 point cut is maybe going to help you $80, $90. Probably not worth the time, effort, and energy. What I love to tell folks right now is reach out and see if you can find a lender that can help maybe cover some of the closing costs, or at
Hmm.
minimum roll them into the loan so you're not coming out of pocket with them, and do them in a way where you're minimizing the amount of fees or points that you're paying up front to get that rate. Because again, knock on some wood somewhere, hopefully come 2025, we're going to continue to see interest rates, the Fed funds rate first, and then hopefully trickle down into the mortgage rates, decrease some more, and really, really start to help consumers get off the fence, sell their home because they're wedded to their 3% mortgage rate, and really help out and change the dynamic of our still somewhat low housing inventory that we have right now.
Yeah. And I know that like you and I are very like-minded, that we really like to help people, and we really like to get creative in how we can help people. And I know that we've had many conversations, over the past couple of years about like what's happening and what can we do now. And I even think, and I don't want to misquote you, so definitely correct me if I'm wrong, but I think that you guys even have some program about refinancing that doesn't cost as much as other banks, because it does cost money to refinance. You had something that you were talking about. Do you know what I'm
Yeah,
referring
I,
to?
I do. We offer what we call lender paid closing cost refinancing, or total closing cost paid refinancing, where we simply just take whatever the balance is, whatever other things they might want to do. Maybe they need $30,000 for a new bathroom. We put all of those figures together, and then we search for a rate where we can cover the closing costs inside that interest rate and still lower the customer's rate. That's what I call the win-win solution, especially for these folks that are maybe out there with a 7 or a 7.5% interest rate. I talked to quite a few of them today. You'd be surprised how many people bought and gained equity during that time, because
Right.
we did see the market appreciate really nicely. Actually, I was just doing some numbers recently. Nationwide, over the last 5 years, we've seen about a 32% increase in home value. So
Yeah.
imagine all those folks that maybe they did have a higher rate, but now they can refinance and they've built in their equity. And that's a really nice way to look at it. I also think a lot of folks are looking at some of the shorter term loans. We are starting to see some of those in the fives. So some 15-year fixed rate mortgages in the mid fives. That's a really great option for somebody who maybe was in a 7% rate and can afford a higher payment and
Right.
wants to really start tackling the principal quickly. So,
Yeah.
so many different options out there. And of course, so many different consumers out there, and each and every one of them with an individual need.
Yeah, exactly. Let me ask you a question. Can you work nationally, or I mean, I know you're based here where I am in the DMV, we're DC, Maryland, Virginia, but can you do loans all over the country?
I cannot personally do all over the country. I'm personally licensed in Maryland, Virginia, DC, Delaware, Pennsylvania, Georgia, and Florida.
Oh,
But
wow.
Origin Point Mortgage is almost nationwide, almost all the states.
Okay.
So definitely a great company, and we have pretty much an outlet and a resource for every area. So if there's someone out there listening across the country that might need some advice, let us know.
And when we talk about the different loan products, I mean, we've got the conventional loans, we've got the government loans, FHA or VA. Is what you're saying, is that across the board, or is that specific to only conventional? Like, can you elaborate a little bit on that?
Yeah. So first of all, let's start a little bit with VA loans, right? They're the most amazing loan for a consumer that has served our country. So, first and foremost, for any of you out there that are serving or have served, we really want to thank you. And we have no lender fees. Most lenders will not have lender fees on VA loans. And those VA loans also come with incredibly low interest rates. Right now, those are in the very low fives, really helping our veterans to get into homes, and keep that affordability available to them. And again, all depending on the veteran, they might have some type of a disability that would also allow them not to have to pay what they call the funding fee.
Right.
As for FHA loans, those are the loans I say are that great first-time home buyer loan program. As little as 3.5% down payment. The debt ratios can go extremely high in case you've got a first-time home buyer that maybe has a car payment on top of it or some student loan debts because they're young and they're starting out. This allows them a really great opportunity to also get a low rate into the fives, low down payment, very forgiving on credit scores, and allows for that higher debt ratio. So what a great first-time homebuyer program is the FHA loan, and an extremely popular.
Yeah.
For conventional loans, or in our market, we have something in the Montgomery County area and many parts of DC and Virginia. We have a conforming high balance loan because we live in an area that has a higher area median income. And those loans right now are almost going all the way up to like 1.1, almost 1.2 in loan amount.
No.
And those rates are also pretty nice in the mid sixes. And then you've got the jumbo, and the jumbo is really for someone that maybe fits in a specific criteria, needs a really big loan over 1.2, 1.3 million and up. These loan rates can really vary, but credit score is a huge criteria for those. The higher that credit score, the better their options.
Yeah. So what would be the good credit score? Is it still the 780? Is that around that number? Or has it changed?
No, 780 is really the marker to get what I call the very best rate out there. We consider that excellent credit. And there are a few folks out there even with 800 scores, but normally between 780 and 800, you're not going to see a difference. Where you're going to see a difference to the negative, meaning a higher interest rate, is when that interest rate drops lower than like 700 or 680. That's when, if you're in a jumbo world, you are going to definitely be paying a premium for that interest rate.
Yeah, when your credit score jumps lower. Yeah, I hear you. And also, when we were on last week, one of the viewers asked about, kind of local programs to help him out for different grants or first-time home buyer, or just different things that are offered for somebody that is a first-time home buyer or maybe has a certain salary that really wants to get into the housing market. Do you know about those as well?
We do, and almost every jurisdiction or state has local down payment assistance programs. They have them in Maryland, in DC, and Virginia. They have them in Pennsylvania, in Delaware, in Florida, in Georgia. I can't speak to the states that I'm not licensed in, but I have a lot of friends who tell me all the time in other states that pretty much every state has some type of a down payment assistance program. Usually they're income restrictive, right? So they're making sure that they're helping those who truly need the help. So if you're out there making $500,000 a year, you probably don't need the down payment assistance programs. We also have some unique programs where we give up to $8,000, just not even based on where the new property will be, but where they're currently living, because maybe we can see that that person is currently renting in an underserved area, and we can help those home buyers with some tax down payment assistance programs and grants that way. So that's a really unique program out there. And then I think what also is really helpful is these high debt ratio loans where, you're trying to buy a home, but you couldn't help it. You had student loan debt, or you have a car loan, and it's expensive to have a car loan today, and you just don't qualify, but you can afford the payment, or maybe you're a multi-income household where we're not putting everybody on the loan, but everybody's going to contribute to the mortgage. These are the types of loan programs where they'll allow an expanded debt ratio to go slightly higher than the norm of 45 or even 50%. Some of them will go up to 55%. And there's just so many different programs out there. And that's why it's important to connect with folks that really know your exact financial situation, and they can help you ascertain the perfect mortgage. I always say mortgages is like, going get fitted for a suit, right? You're tailoring the suit to fit your needs. Somebody's going to lift up your arms, measure your inseam. The
Right.
same for mortgages. They need to be tailored to your individual needs, not your neighbors, not your cousins, your needs. And everybody's needs are different.
So that's so interesting. So you could have somebody that maybe, like you said, has more debt because of student loans or a car or whatever. I mean, stuff that they just have, but they have the income, or they're living with their spouse, partner. I don't know if there's a qualification on who else is participating that also has an income, but they're not necessarily going to be on the loan. Was that correct?
Right. They're not going to be on the loan, but you, the customer, know that they're there and they're working. They're just not on the loan for whatever the reason is. So they're going to contribute to the household.
Right.
But if you needed that extra ability for you personally to qualify for more, we have allowable programs that allow debt ratios to go up to 55%. And then that way, that customer can buy the house at that higher debt ratio, knowing that they've got other people, because we would never want one individual to be so tapped out at their own 55% of their household in total debt at 55%. But these programs, they exist. Maybe your partner hasn't gotten citizenship here yet, or maybe their income is too hard to verify, or maybe they had a credit incident that made it so them going on the loan was at a disadvantage. These programs are out there to still help the family unit, whatever that family might be, a single individual, a married couple, same-sex couple, folks with kids, divorce, all those things. That's what they hold. And I love that now, because it didn't used to be like that. It used to be very pigeonholed to like the complete nuclear idea of family. And that's what's been so great about these programs.
That's really cool. I actually didn't know about that. So I'm so glad you brought that up, because there seems to be just so many options for people that they may not know. And like you said, it's important for if somebody is thinking about getting into the housing market to speak to a mortgage broker, a mortgage lender that really has all these different options for them to explore to see if something works for them. I mean, you might just go on like this internet site, putting in your numbers and think, oh, well, I can't buy a house, but you just never know. You never know until you explore all the different programs that you have. Are you seeing a lot of like ARMs out there as well now? I know they used to be really popular back in the day, and then they kind of went out of fashion. Are they back?
They're not back. No, not in the way that we need them to be. In the jumbo arena, a little bit, but not enough to really move the needle. Maybe you're going to see a jumbo rate about 0.25% better than a fixed rate. I don't think that's enough to make folks not want to take the fixed, 0.25%, unless they're really certain that they think the rates are going to drop in 2025 and they're going to quickly get out of the ARM. Then perhaps, or maybe they know that the house is a what I call a Band-Aid home, where they might just be there for a few years and then they're going to sell and buy something else. Then an ARM product might make a lot of sense, but not a great idea to go into an ARM unless you see a significant difference between the products, or it's need-based, like I had mentioned the reasons before.
Yeah, so I remember like back in, before the housing market really did crash in 2008. People were getting loans just by signing up for them. And there were so many 5-year. I remember there were like 2 or 3 year ARMs and 5-year. And then all of a sudden, like their interest rate just changed dramatically and they couldn't afford their payments. And then we ended up with all those short sales and foreclosures, which fortunately I don't really see a lot right now. I see a lot of like people on YouTube talking about the foreclosures are crazy and they're out of it. Well, I'm doing my own research. And according to Adam, let me just bring this up. I can't see without my glasses. I don't know why I pretend to, because I just
I've had mine on. And of course I see further away. So now I'm going to take mine off to read what you're showing.
I know. All right, hang on. So I brought this up. Now this is October 9th. So just, last week, U.S. foreclosure activity decreases in Q3, the third quarter of 2024. And Adam is a leading curator of land, property data, and real estate analytics. And they just released this foreclosure report, which shows that they are down. And Rob Barber, the CEO of Adam, always has put this disclosure out. While we are seeing a decrease in foreclosure starts and repossessions, It's crucial to remain vigilant as any economic disruptions or changes in interest rates could shift the current trend. Moving forward, we anticipate foreclosure levels will stay relatively low, but there could be localized increases in areas struggling with affordability or other market pressures. And as we know, real estate is very localized, and what's happening here where we are in the DC area is very different than other parts of the country. I mean, I don't know how the states that are, and I feel terrible for them, that are truly have been affected by these hurricanes, the Floridas, the North Carolinas, how that's going to affect their economy and their housing market. I mean, it's just devastating. But I can imagine that this is a national statistic, but it's probably not true everywhere in our country. There's probably places where foreclosures are quite high. But in general, it's not what people are saying when I see these people on YouTube just, screaming the housing market is crashing, the sky is falling because we have all these foreclosures. I certainly don't see them. And when you were speaking at our office meeting, the metrics that you were talking about, which are very important, were the credit card debt, stuff like that, more so than foreclosures.
Right. And also after 2008, I think the banking industry really learned a really valuable lesson, which is, it's one thing to help someone get a loan by stating income. But stating income and then no money down, there really is no risk in walking away from the home, which is what we saw in so many markets, where then all we needed was a slight drop in the value of homes, which happened. And then people walked away. I can recall it very well, driving down a street in Nevada and literally seeing, I think it was 7 foreclosure signs in a row almost on one street. It was mind blowing. That's not going to happen, in my opinion, this time around, even if we have a housing market switch. And I think the reason because of that is because now the banks really make you document your income. Or if you're not going to document your income, they're making you put enough skin in the game that you don't want to walk away from your home. Because it was easy. Some of the people that even walked away from homes weren't even folks that couldn't make their mortgage. They just were watching their equity plummet, and they thought, why stay? Like, I'll never be able to make up this deficit. So it was a really unique time. And that was the last, I think, really huge crisis for mortgages and for the housing market as a whole. And I do think you hit it spot on, Caryn. It's localized, it is market, and in the metro area, in the DC market, where we are, you're not going to come across that much of the foreclosure. And maybe again in certain pockets, maybe, but I really think also the other piece is folks are always going to do their very best to pay their mortgage debt first. I have seen that time and time again. Hence why we also have the credit card problem that we have right now. So I think what you're seeing right now more than ever is this incredible amount of credit card debt, because folks are struggling. Folks are having a tough time keeping their jobs. And so therefore we're in a tough spot in some of these markets.
I know. And that's when it gets a little confusing to me, because you see these metrics of this incredibly high credit card debt. You don't see the high foreclosures nationally. Obviously, like we said, it's localized. And then you hear about inflation and the economy and the Fed, and it all kind of gets jumbled. Like the jobs report came out, and that's great. Okay, so people are working, but the credit card debt is so high. So people are working, but they're spending all their money, living their life off of credit. Like it gets very confused and confusing to me, and I'm in this business. And then add the housing market on top of it, where literally it's definitely softened. It's not like it was a couple of years ago, for sure. Even where we are in the DMV, I see a lot of price reductions. We had the CEO of Compass speak yesterday at our mastermind. He was saying price reductions across the nation are 40%. So 40% of the houses have a price reduction. So that's almost half of the houses are having price reductions. I can imagine a lot of those are greedy sellers, but some of them are just like the market's softening. And I can, so it's definitely changing, and that's for sure. Am I still seeing multiple offers on houses? I am, if they're priced right and they show well. but in general, it's softening. But it just becomes very confusing to me, and I imagine other people out there, when you see all these different metrics coming together. Like you got all this credit card debt, but good job, inflation, and then you go to the grocery store or the gas station, and it's like so expensive.
I mean, I'm blown away at the grocery store. I don't know about you, but I get blown away when I go to the grocery store lately. I mean, a bag of grapes, $8, $9. I mean,
Crazy.
imagine
I
imagine
know.
if you're a household and you know, you've got a couple kids that grab a handful at a time. They're gone in a minute, and that's a lot of money.
Yeah.
And I'm also noticing more and more people being really careful on how they spend dining out. I've noticed that has dropped a little bit. I've noticed that there've been shorter lines at the Starbucks, different things like that that let me know that people are feeling it. They're feeling it at the pump, they're feeling it at the grocery store, and something's got to give. Um, but I also think I think with every challenging market, there's always opportunity, right? So
Mm.
you and I were chatting about that, and all the numbers show that the market for housing should be very strong in 2025. So we've got this election coming up for sure. And also, that is another, I would say, quiet time, right? So, somebody just chimed
Yeah.
in, I think.
Because
So
election equals disruption.
it does because our country is incredibly divided at this moment, and more so than probably in our history, in our lives, Caryn. And so I think this is just a really unique time to kind of watch people take stock in things. But I also think there's opportunity. I think that slowly after the election, it's going to go back up like gangbusters. That's my take. I could be so wrong. I don't want to be quoted if I'm miss the mark on this one. So I think there could be some really good opportunities to maybe get a property at a good deal right now, and hopefully hope for some strong appreciation in the following years to come.
Well, you did say this earlier, and I agree with you that people that did buy, in the last couple of years with the higher rates, their homes have gone up in value, especially around here. I think we're at 31% since 2020, and even 3.5% year over year, but that's still up. Do you know what I'm saying? They're
Right.
still gaining equity in their house, and hopefully they can refinance if it makes sense, if the rates go down enough, depending on their loan amount, to make sense to refinance. But the property values in our area is still going up. Now, I know that's not everywhere, but it is in a lot of places, around the country. So I agree with you, especially now in the fall. It's kind of time that you could make a deal, in buying a house, as opposed to the spring when everybody's putting their house on the market and they all look good. And that's the most popular time, at least around here. Actually, I think in most markets in our country, where it gets more competitive, more competition, prices go up. Right now, when it's a little softer, if you are qualified to get a mortgage and you do see a house you like, I do think that it is a good time to possibly get a better deal than the spring.
Yeah. And in 2020, remember those folks that were multiple bidding? They were scared to death to multiple bid, but they did it. And now we had that saying a few years back that was marry the house and date the rate. And that's exactly what they did. They just dated that rate for a couple years, and it's really panned out. And I think there's possibility for that. And, we also have to remember there are other life events other than just mortgage rates that dictate our housing market, right? We have additions to families, we have divorce, we unfortunately have death,
Right.
we have illness where somebody has to go into assisted living, and a lot of other smaller factors that are very specific to the unit that cause people's timing to necessarily not always be by now it's the spring market, by now it's the fall market. It could be December and it's I gotta sell because I'm getting a
Right.
divorce.
Yeah.
And those are other indicators that folks have to put into the big plan. But it's not uncommon around the time of an election to see the market quiet. Folks don't know exactly what to make of it, and so they're a little gun shy. But a lot of times with risk comes reward. So sometimes being a little gun shy works, and other times you might have missed out. We don't know for sure, but I love the dialogue here because there's just never a one right answer for every person.
So this is not a political channel, and I don't want to get into the politics of it, but there is an election in a few weeks. I've been doing this for 22 years, so almost as long as you have. And I've been through many elections, and we're right in the heart of it in DC and Maryland, Virginia. I've never really seen elections really matter to the housing market. A lot of times these people come in that are going to change, jobs, and they just rent. And I'm not in the rental market. I'm only in purchase. This year feels a little different. And then we were talking about in our office meeting, this year feels different. It just feels like it's just more, there's more at risk. There's more, a lot of the talking points on both sides are about the housing market. They're very different on what they say they're going to do to help the housing market. One is less regulations. One is more, money given to first-time home buyers, more programs to help stimulate, and help. Very different, but both focused on the housing market. Do you have any, without getting political, do you have any feelings about what you think will happen in the mortgage lending world? I mean, as far as interest rates, as far as applications, anything that you think, I'm not going to hold you to it, but you think will happen?
It's real. This is a loaded one. I don't know. I
I
think
know,
that
it's hard.
I think the tough part is that we are facing an election of what I would call our lifetime, because of the division in the country.
Right.
And so normally I would say it'll all go back to normal shortly thereafter. And I still want to believe that's going to be the case. But I'm also not quite sure if we're going to know who the president-elect will be on election day, or
That's a good
even a
point.
week
Yeah.
later. So, and again, I don't know necessarily that should be the deciding factor for a lot of folks on what they should do. I mean, unless they're in the political sector themselves as an employer or an employee. But what I would say is that it's going to be interesting to watch it unfold, and that I really hope that folks, no matter what side of the fence that they're on, can connect together and unite.
Yeah. I know it's a complicated election, and it is very divisive. I agree with you. Regardless of that, because it is happening in a couple weeks. And I agree with you. I don't think we're going to know right away either. It might take weeks. But the Fed is saying that they still are planning on doing several rate cuts before the end of the year. Now, I know that doesn't mean it's a direct correlation to mortgage interest rates, but there is some relationship there, So do you still see that happening? And do you think that you guys as mortgage lenders are already building that in your rates now, or are you kind of waiting to see what will happen?
I don't think it's being built in yet. It'll get built in when they are pretty certain about the amount of the cut. Originally, the cut was going to be another 0.5%. And now, because of what we're seeing across different economies and different reports that are coming out, and also thinking that maybe inflation isn't where we wanted it to be still, they're talking about 1/4. So I think I would stab and guess that you're going to see, if we're going to see a rate dip, you're going to see it within the next 10 to 15 days. That's
Oh,
my
wow.
gut on it.
Okay.
Because the next rate cut is in November. So I think the banks, the mortgage companies, I believe, always hedge the market. In the 25 years I've been doing it, I've always watched, and I've tried to help guide folks, because they'd always say, I'm just going to wait for the Fed. Once the Fed goes, then I'll lock in. I say, please don't, because
Right.
it's actually already in the rate today. And that one I definitely nailed this time. I told everybody, get your rate locked in. If you are buying in the next 30 days, get that rate locked down as soon as you go under contract. And I think it's really helped benefit a lot of folks.
And how long can you hold on to that lock once you're under contract?
Well, it depends on your closing date. So it depends, right? The more days that a bank has to hedge the market, the higher the rate would be, right? So a 30-day rate lock is going to cost a customer
Less.
a lower interest rate,
Yeah.
a better interest rate than someone who has to extend out 60, because neither one of them is delivering the next day. It's delivering at that time. So they're hedging a market for a longer period of time, risk, reward. That rate's going to be higher. So sometimes you can even reach out to a bank and take a 90-day rate lock. I don't think I would in this environment. If I wasn't going to go to closing for 90 days, I would float the rate for as long as I could and try to get locked down within a 30-day period, just because while rates have been volatile, I don't think we're going to see rates go up any significant amount. We've just seen them go up some from where they were 3 weeks ago. We're not talking about like they were at maybe 6.1, 6.2, and now they're at 6.5. Again, not a huge difference. It's just everybody was anticipating we're at 6.2, we're going to see 5.9. I think we probably won't get much out of the sixes, if we even get out of the sixes on the conventional loan, until the end of the year and into 2025. That's my gut on it, but not sure.
So do you foresee, and once again, nobody has a crystal ball, I get that. But do you foresee a world of 2025 where rates are below 6?
Yes, I do, because I think that we're going to continue to see rates drop throughout 2025. I think it's going to be an extremely busy housing market. I think a lot of people are going to get used to these rates. They will be selling their homes. They've been in their homes a long time and they haven't wanted to be there. And they're eventually going to say, it's time. It's time to list. And I think with more inventory is going to, really start to see the market improve.
Right. Which can then lead us back to what we were saying before. If we think, and once again, we don't have a crystal ball, but if we think rates are going to go down and home prices are going to go up, it's better to buy now when home prices are softer, than in the spring. I am not as convinced as you are that people that have locked in, like I have, and I think you have as well. I refinanced in 2021. I have 2.675 or something like that. I know there's a lot of people like me that I thought, well, I just became an empty nester a couple months ago. It's time to like sell the house and move into the city and, do all that stuff. It's cheaper to stay in my house out here in Potomac than it is to do that. And I know for myself, and I know people that I've spoken to just socially, going from a 2 point something under 3 to a 5 point something is still kind of a big stretch. It's a lot more money. I think rates, before the pandemic, they were in the 4s. They were in the 4s for a while. If you had good credit, certain loan programs. I think if they can dip into the 4s, it's a whole other ball game. I don't know if that's going to happen next year. I don't know if if that's, but so we'll see.
I don't expect. I think when you saw rates in the 2s or 3s or even 4s, to me, that's a rarity. In the 25 years of doing this, that's not where mortgage rates lived, right? Mortgage rates, by the way, this is actually a really good rate at 6.4, 6.5%. It's not a bad interest rate. It's just a bad interest rate when you compare it to pandemic interest rates, or around 2008 when the crash happened and rates dropped and then came back up. But what I would say is there's always a need for folks. And I think even in the rates with the 5s, we're going to start to see people get off the dime. And a lot of folks also are looking to move out of areas or into areas or downsize. I've noticed a lot less builders building those McMansions and building more modest size homes too. I don't know if you've noticed that, but I've seen a lot of builders not building the big, huge monsters like that were on every street corner, and now building a home that's more affordable, and still is a nice size.
Yeah. I mean, I don't see that so much in Montgomery County. You have a wider berth and where you work. Here in Montgomery County, prices are still high, and the builders I see are still building those really expensive homes. But you're right. I mean, there are people that are going to want to move. We just got a comment here, all I know from sorry, I can't read. I can't see.
It's okay.
No, I keep pretending I can. Be Schwavy. Be Schwavy. All I know is it's time for me to leave Florida. LOL. I mean, I'm sorry, because you're probably going through a hard time. You don't know where you are in Florida, but Florida got really badly hit. And with, all that severe weather comes higher home insurance costs. Everything becomes more expensive, not just repairing your home, but insurance was already so expensive in Florida. I know unfortunately, my stepfather passed away a couple years ago, and my mother took over, their house, and I had to get her new home insurance, and it was so hard. And they were already established and had equity, everything. But it was like, oh, we don't insure in Florida anymore. We don't insure in Florida anymore. I'm like, what do you mean? Like, people live there. I don't get it. But I guess there's just so much risk there. And now they get hit with a hurricane. Between the damage and the higher living costs, I can imagine a lot of people are going to want to leave. So I don't know where you live in Florida, but I hope you're okay.
Yeah, I second that. And I do think that was a great comment to bring up there, Caryn, that insurance is set to go up again, even if you're not in Florida. I mean, and I think it's just a terrible thing that to protect yourself, you have to spend so much money. Seems so completely unfair. And
Yeah.
I think we have to really watch out for the monopolies out there too, because if and when these claims start happening and more insurance companies, leave states, it just allows the folks that are still insuring in those areas to just really charge whatever they want to, because
What choice? I mean, what choice do the
what
people
choice
have?
do,
Exactly.
what
Yeah.
choice do the people have? What choice do the people have?
Okay, let me switch gears to something a little bit more hopeful. I feel really bad now.
I hope I'm not doom and gloom.
No. I just, when I started to think about the hurricane, all the people, I have very, very, very close friend of mine whose family's in North Carolina at Nashville. And it's just like, when I start to think about it, it makes me really emotional, because they're just really struggling right now. I want to talk about assumable mortgages, because there's a lot of hype out on the internet, on YouTube, everywhere, saying you can get, a low amount mortgage. All you have to do is get this assumable mortgage at 3%, and it's really easy. And, you should be doing that. I had a call just last week by somebody who was a seller in our area. And he said, my deal just fell through. I'm not sure I want to stay with my agent. The buyer my loan is assumable, and the buyer was going to assume it. Well, now it's 6 months later, and all of a sudden the buyer said they can't do it. I don't really know what happened. And now I'm back on the market, but 6 months of days on the market, and I don't know what to do. So please tell us, it's not as easy as it seems, is it?
Well, it's a loaded question. On VA loans, okay, you do not need to be a veteran to assume another veteran's VA loan. And often veterans have those really historically low rates on their mortgages.
Yeah.
The biggest problem with an assumption loan is writing the contract in itself, because what you don't know is how long that assumption department is going to take. And you also have to keep in mind, again, that banks are in the business of earning money. So when they are thinking of all the divisions that they're going to have, whether it be underwriting, processing, all these different departments, the assumption department is not like this massive department, because the last thing the bank wants to do is have someone assume the loan at a low interest rate. That could have been a customer who was going to instead get a mortgage rate in today's mortgage environment. I'm not saying in any way they're holding on to the documentation and not doing it, but I'm letting everyone know who's on the call that there's a few reasons why they're not that easy. One is that 90% of the time, and again, I'm not an assumption lender. I don't want to pretend to be one. I don't play one on TV. But from the assumption lenders that I'm familiar with, whatever the balance is all you can assume. So if you've got $1 million purchase price and the assumption amount is $800,000, you've still got to come up with $200,000 to get that money. And the assumption lender is not going to lend you greater than whatever the amount that they're assuming is. Right. I strongly urge folks that want to advertise an assumption on their mortgage that their very first call, maybe even before they get to their realtor stage, is to call to their assumption department, find out, is there a kit or documentation packet that you can send me so I can start filling out the paperwork, so I know if my loan can be assumable, what I'm looking at as far as timelines. I have seen some of these assumption lenders take 60, 90 days, and they'll call me and say, Francki, how can you help? That assumption is only with that servicer, that lender who's holding the note. They're the only ones that can help you with the assumption because it's their money and they're just going to pass it on to a new person. But what is nice to know that it is if you are trying to assume a VA loan, you do not need to be a veteran. You should
Oh, wow.
always be you should always be owner occupied in that dwelling. If you're not going to be owner occupied, again, you need to be reaching out. And as the buyer, you don't have the right to reach out to the lender because you're not the customer yet. It's still the seller who's the customer who has to get all their ducks in a row. And so I think the most challenging part is knowing when to put in your contingency dates and contracts, right? Is it going to take 30 days to get our financing in place, 60 days, 90 days? Are we going to have to keep extending it? We don't know. So
Right.
if you have a loan that's assumable and you think that you want to advertise your low rate with it, make sure that you connect all of those other dots up front. Make sure you communicate with the agent up front and know that you're not working with a new lender. You're working with the seller's lender.
Yeah, I guess that's what happened. And then when it didn't work out, his house had already been on the market for so long, it, had gone stale. We got a little update by our Florida friend. Currently in Tampa, insurance is crazy. I want to come home to Northern Virginia and buy my first home, but prices in Dallas, Austin are cooling. I have heard that prices in Austin, I don't know as much about Dallas, have been cooling. One big part of that is they were so inflated during the pandemic. Austin was one of the boom towns that really went crazy. And I don't think that the actual living wages can support it. So the prices are cooling. So if you're going to think about Austin, we can help you. If you need an agent in Austin, we can help you with that too. But come back to the DMV. It's nice up here. And then we have
Get all the seasons.
Yeah. We got
You're not boiling hot like it is in Texas.
Mohammed Rafi Arman says mortgage rate already down, but it doesn't solve the problem. Home prices itself is high. The buyer is not returned anytime soon. So I think what you're saying is that yes, even if mortgage rates are down, home prices are still so high, and you're not wrong. Home prices went up so much in the last 4 years, and like I said, in not most, but in many markets in our country, they're still really high. It just depends on where. I pulled up this data that I thought was really interesting. I'm going to share my screen again. Hang on. Okay, this is a really interesting metric. So this is about inventory for sale compared to pre-pandemic, right? And then home prices in each metro, respective peak in 2022. And this data is brought by one of my favorite data, what's the word? People that gather data gatherers, Lance Lambert. So he's got his own publication, Resi Club, but he writes this also for Fast Company. So if you plug it in, it's a whole article, and I just plugged in where we are in the Washington, D.C. area. It shows how inventory in September of 2024 is 9,798. In 2019, it's almost double, 15,412. And the year before that, it is double. So what he was basically saying is until inventory becomes more now than it was pre-pandemic, home prices are going to stay high. And then the next map, and if anybody wants a copy of this interactive map, just text me or email me and I'll send you a link to it because I thought it was really interesting. You can plug in wherever you are. So back to our area, this is the month over month, and the shift changed since the 2022 peak. So the 5-year change in our area, this is home prices, 31.6%. 1-year change, 3.2%. And this all has to do with supply and demand. Obviously, if there's more demand, there's supply, prices stay high. So depending on where you are in the country, and this is, I could probably get into, let's see, where Austin would be here. Okay, so we have Austin here. So let's go back up here for the inventory first. Where is Austin? Okay, so inventory in Austin in 2019, 7,640, or even a year before, 8,364 units. Inventory in 2024 at 10,719. So it's more now, a lot more than it was pre-pandemic. But the home prices, cutting that here, the 5-year change, 42.9%. 1 year, it's down 4.6%. And look at the 2-year, down 15.5%. So that just shows you how different it is between Austin and where we are, simply based on the metrics of home prices and inventory. And it goes on and on depending on where you are in the country. But it's a great map that I really thought showed just how different it is depending on where you live. We got another comment. Assumable mortgage is in the DMV. Yes, there are assumable mortgages in the DMV. I know that because this person that called me is in the DMV who had the assumable mortgage that unfortunately didn't work out with their buyer. I don't know.
And assumable loans are nationwide. So it just has to do with the caveat of the type of mortgage the current person that's selling the home has and whether or not their loan is in fact assumable. And on the day of your closing, there is a document inside what's called the Truth in Lending Disclosure. That will be a box checked. My loan is assumable. My loan is not assumable. Mortgages in general are not normally assumable, conventional loans. But there are some adjustable rate mortgages back in the day that may still be out there that are assumable. There are some, VA loans are always assumable. And sometimes there are government loans that have been done back in the day that have an assumable feature. But it is 100% one of those things that I would never even take the word of a seller that their loan is assumable until you gather the data. I wouldn't put it as part of the marketing until if I was an agent, until I saw the paperwork myself, made sure of it, because it is a time consuming activity. And like I said before, you do have to bridge the difference, right? So it's not you're assuming the price of the home, you're assuming whatever's left on that seller's balance sheet.
Mm-hmm.
So keep those pieces in mind. I wanted to go back and talk for a second, if it's okay with you, Caryn, on the gentleman that said prices are still too high, right? Which I totally understand. I can't imagine how hard it is for especially a first-time home buyer in our marketplace. And I imagine that people feel that all around, because also price does correlate to the income in a certain area median. So one thing I thought I would share was that the buy down program is still a pretty popular program, and in a hopefully decreasing mortgage environment, that there are loan programs out there that can sometimes give you a reduction in interest rate of up to 3% the current market. So imagine you're in a mortgage and you close on a loan that's rate is 6.5. In year 1, it's 3.5. In year 4, it's 4.5. In year 3, it's 5.5. And it takes all those years before it gets to 6.5. And during that time, again, maybe life happens differently. We often get pay raises year over year. We sometimes add more people to our household that can help contribute to the higher mortgage. So there's so many folks right now out there that are still taking advantage of the buy down loan programs that are out there. And the thing that I always like to let folks know is if mortgage rates drop too much, those buy down programs will go away, because there'll be no need for them. There'll be no appetite for them. So you've probably been hearing about buy down since when? Right as 2022, the mortgage rates started to creep up. That's when buy downs came out. They're still available, even though the rates have trickled down. They're probably going to be on their way out sometime, my gut tells me, in 2025. So if you're looking for that teaser rate, and again, it's so important to know, don't take those loans if you can only afford the teaser rate of the buy down program. You have to be able to still afford the other rate, but you just want a little bit of a break. That's why you would take the buy down programs.
Yeah, but you have to qualify for the end rate, correct?
You do qualify at the end rate. And again, I want folks to assume that they're one day going to pay that end rate. They may not, but they could. And so again, the idea is it's really great for folks. Like I had a few people over the last couple of years where they were a 2-income household, but they were having kids and they were going to drop down to a 1-income household. for about a year or 2 years. And so they picked the buy down because during those couple years, they know they can go back up and afford the higher payment when they both go back to work.
Yeah, that's a perfect example. I love that. And it makes sense. And listen, will home prices soften in the future? They might. I mean, they're already softening. And like I just showed you with Austin, those home prices, because their inventory is more than it was pre-pandemic, are definitely going down. But they're still way up from pre-pandemic. They're still 30% higher than then. So depending on how long you're going to planning on staying in a house, it used for me, and I'm sure you're different as a lender, for us in real estate, we used to say, well, if you're going to be there at least 5 years. Well, then I started saying, if you're going to be there for at least 7 years, because things got so crazy. But if you're going to be there for an extended period of time, it is an investment that you hope will appreciate in value. Meanwhile, you're building equity. Meanwhile, you have certain tax write-offs. And there is the possibility, I don't really love the whole marry the house, date the rate thing, because I don't know. It doesn't work well for me, because I always think, what if rates don't go down? Then people will have this false sense of security. But I understand it. And it worked in the last couple of years. But there is always the possibility that rates could go down. Whereas if you're renting, the possibility of your rent going to go down year over year is not as good, in my opinion. Although I don't work in rentals.
Well, I think year over year, they only increase from what I've seen. You're not seeing a decrease in rents.
I did not know, and Slippin' Jimmy says this too, I never knew about VA loans being assumable. I knew that VA loans were assumable. I did not know that you didn't have to be in the VA to assume them.
That's right. You do not need to be a veteran. You do not need to have served in the military. So there's a lot, and it's I think it's a 1% fee that the VA will charge the customer, which is about the 1 point that you might pay to buy an interest rate down. So I don't see any downside at all. And they have lower fees and lower closing costs. I think the biggest piece is just knowing what that true balance is and knowing how well that lender does assumable loans. Because again, if they're at 90 days out to close that assumable loan, it may become an unattractive feature in selling it. But again, maybe I'm sure with as many stories as we hear about how long they take, I can imagine there are some people that were able to assume loans rather quickly.
Yeah, it's definitely, listen, why not look into it? If the seller is willing to do it, because it's their house that's going to be off the market for the period of time, if depending on the contract, obviously. But if the seller is willing to entertain it and has all the paperwork and their ducks in a row, and you can get an assumable loan and you can pay the difference, like you said, the difference between what the actual loan amount is and the purchase price and your closing costs, it could be a great thing. But I love that you brought up, the buy downs and other programs, especially local programs for first-time home buyers, or depending on your income, different grants. I know some communities have different grants. So I've heard about some, like you can take a class being a first-time buyer, and that helps you with certain credits in certain areas. There's so many different things that, as a real estate agent, to be honest, I don't know all of your different mortgage programs. I feel like I know great professionals in that area that I can just send my clients to that can explore depending on their specific situation. And I can focus on what I do best, which is like finding the houses, negotiating the contract, the inspections, everything else. And that's why we make such a good team.
Exactly. And I feel like, just as I may not know the difference in quartz and countertops, that's your area of expertise, and how many square feet, and if you will be able to fit that bed into the space, and all the things, and most importantly, the negotiations and deals and your value, Caryn. There is a lot of talk lately, but the value of a seasoned realtor really is immeasurable. This is one of the most expensive purchases you're going to make in your lifetime. You need to be working with folks that understand, that you can trust, that know the value of real estate, know how to collect the data, like the market analysis that you all do called CMAs. I could go on and on about the things that realtors do. And I have to tell you, I'm constantly blown away at the hours and hours, countless hours that realtors take to make sure, especially you, Caryn, to make sure that the consumer is really well protected. And I can't imagine ever trying to navigate that without a trusted realtor.
Let me ask you a question. Have you had a lot of questions since the NAR settlement about people coming to you saying, "Oh my gosh, now I have to pay," because I know what's happening in my end in the real estate market, but just as a lender, have you had a lot of buyers come to you and say, I can't afford to pay my buyer's agent, so I'm just not going to use one. Have you had any of those conversations or not?
Luckily, I have not, because I feel like people know that this is like truly the most important big financial decision of your lifetime, and that there is value in it. I mean, you know, you hear horror stories of people buying houses going unrepresentative. The next thing you know, the house was a lemon. I mean, it'd be terrible to buy a car that was a lemon. That's going to affect you for a couple years. Buying a house without representation is just crazy. So I'm very blessed to say that I have not heard of anybody who doesn't see the true value in having a representative guide them and empower them and educate them each and every step of the way, to ensuring that they purchase a home with true knowledge and education at the forefront.
Yeah, thank you. I was just curious if you did. I mean, in my world and the real estate world, I have seen, people definitely have a lot of questions, and they should, and I'm happy to explain it. I've done videos on it, kind of what's happening. But what I've seen in practice is that a lot of sellers are still cooperating with buyers agents to help them pay for their agent. And so we really, at least where we are in the DMV, haven't seen a lot of buyers really having to come up with extra money to pay their agent. Not that it doesn't happen, everything happens. But in my practice, in my experience, I haven't seen that yet.
Yeah, I would agree. And, I feel like in any industry, there's value added, right? So, I mean, it's the same with the mortgage industry. You can go online and you can see a complete gamut of interest rates, from, an online lender that has like a 1-star review to, someone that's your local lender that is going to hold your hand, be there on the weekends, help you navigate through programs and products. It's really like anything else. You get what you pay for. So there's value in everything. And at the end of the day, the value becomes immeasurable when you made the right selection because you had the knowledge up front.
I mean, it's your home. It's your home. It's where you create your memories. It's where you have your family. It's your home. It's
Right.
I've been doing this so long, and I've seen so many people, having babies, and then they upsize and then they downsize. And it's one of the benefits and the pleasures that I get and being with clients and repeat clients, to kind of see where their life takes them, and how much they love their home. And I was a part of that, and I love it. And I know that you also add a lot of value, and I really appreciate you. And I'm very grateful that you came on. Let's see, we got one more.
My pleasure.
You have to have, look, I'm going to read it without glasses. I'm not that old. You have to have professionals representing you. It will pay dividends long-term. I agree.
Right.
So, Francki, I will put your information in the description. If you're watching this on the replay, if you have any more questions, we covered a lot. She's a wealth of information. So if you have any questions for Francki, her information will be in the description, or you can always reach out to me and I will make an introduction. I'm happy to do that. She is very, very, very knowledgeable, and really takes care of people and really cares about people, which is the people I like to work with, is that they really support and protect their clients. And thank you for coming on. I really appreciate it.
Thank you. Thank you so much. Before I did this, I see this so much in you, Caryn, and I'm glad your name starts with a C, because I feel like just in buying a diamond, which I was a jeweler, you might not know that, many, many moons ago, that sold diamonds and wholesale stones. And this is, more than 25 years ago. My father had a jewelry store. And I always remembered like the 4 C's of diamonds. And what I wanted to end with was saying that you fit all of those criteria of what I think the 4 C's of real estate are, which are the care, concern, commitment, and, being Caryn. So
You're really sweet. Thank you.
And thank you so much. It's been my pleasure. And I'm just excited to see how your podcast continues to grow.
Yeah, well, you'll have to come back on again. We'll see what happens in the next couple of weeks.
My pleasure.
All right. Thanks, everybody. Bye.
Thanks, everybody. Bye-bye.